Hello and welcome to today's video. Today I will be covering the latest earnings and earnings call from company Strategy, previously known as Microstrategy. This will not be like my other videos covering earnings, as this company is not just classical in terms of revenues and net income. As probably most of you know, it is the largest Bitcoin treasury company in existence today. As this Bitcoin cycle looks more and more to be in its last innings, when I go through missed opportunities in this cycle, Microstrategy is definitely one of the biggest gainers I missed. Reason for that was that I didn't understand their business model enough to make the step necessary to invest in them. So if we indeed enter in another nasty bear market, I don't want to commit same mistake, and this time I want to be prepared in terms of at least understanding this company's approach and how risky it is. So today I will cover to the best of my ability their approach, instruments and other things they are doing to potentially reshape the future of capital markets. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. One of the strategy most important key performance indicators is related to Bitcoin yield, or in other words, how much satoshis you get per share of strategy. As you can see, each passing year you get more satoshis per share. For the reference, 1 Bitcoin equals 100 million satoshis. So 200,000 satoshis equals 0.002 Bitcoin per share at the time of the reporting. This is projected to increase with each new purchase of Bitcoin. Right now, with share price of Microstrategy at $176, with its current holdings 649k Bitcoin and an assumed float of 320 million shares, fully diluted, that would give around 203,000 satoshis per share with the current price of Bitcoin of 91k. For a long time, I stayed away from this company because I did not fully understand its capital structure. It always felt like every few months they were issuing a new instrument, whether it was convertible debt or preferred stock. Only after looking at everything in context does the picture become clear. MicroStrategy has accumulated one of the largest Bitcoin positions on the planet at an average price of roughly 75k per Bitcoin. And at the time of reporting, this translated in a Bitcoin net asset value of about $71 billion. Once you see the scale of that number, the rest of the balance sheet becomes much easier to digest. Convertible debt represents approximately 12% of Bitcoin net asset value, and preferred equity accounts for around 9% of Bitcoin net asset value. Annual dividends and interest are less than 1% of Bitcoin net asset value. In simple terms, the liabilities are small relative to the asset base, which makes the structure far more robust than it initially looks. This outcome is almost entirely the result of disciplined accumulation during the bear market when prices were significantly lower. Being a first mover allowed MicroStrategy to scale aggressively at levels no competitor is likely to enjoy again. If you believe Bitcoin is headed higher over time with less extreme drawdowns, it becomes even more obvious why replicating MicroStrategy position and efficiency will be nearly impossible for any traditional company starting today. MicroStrategy plans to cover its interest and preferred dividend obligations throughout the common equity offering, which does introduce dilution, but the scale is extremely small when compared to the capital the company has raised over the last 12 months, with dividends and interest representing less than 2% of total capital raised and just over 6% of operating income. The impact of issuance is negligible in the broader context of the firm's financial capacity. Financing does not appear to be concerned for the foreseeable future, especially considering that so far they have focused primarily on the US market throughout their preferred equity products, which I will cover in more detail soon. The recent upgrade to a B- credit rating has already expanded their potential investor base from unrated pools into the broader segment of credit buyers that invest in C to BB rated securities. Over the longer term, their goal is to reach the upper layers of the global credit market, where BBB to AAA buyers sit, which would unlock access to much larger pool of institutional capital. Now on to preferreds. Strife. So this product comes from Strategy and represents a long duration senior secure credit instrument. It provides a 10% annual cash dividend, while the effective after-tax yield reaches 14.4%. This number reflects the pre-tax return an investor would need to earn on a fully taxable investment, such as bonds or bank interest, in order to match the after-tax income generated by STRF 9.1 effective yield. The structure is heavily over-collateralized with a portion of strategy Bitcoin holdings. In practical terms, every $1 invested in Strife is backed by $7.8 of collateral. When 1 divided by 7.8 is calculated, the result is 12.8%. Subtracting that value from 100% gives an 87.2% threshold. This means Bitcoin could fall roughly 87% from current levels and Strife would still remain fully collateralized. At the time of the report, Bitcoin was trading above 100k, which highlights the depth of this protection. The senior classification is also important. It places Strife at the top of the payout hierarchy in the event that something goes wrong. Senior investors are first in line to claim collateral and recover value, given this instrument a higher level of structural protection compared to subordinated credit of equity holders. Now onto STRD. So it represents a long duration senior secured credit instrument offered throughout the strategy trust structure. At its core, the product functions similarly to high yield bond, but with an important twist: the entire loan is backed by significant Bitcoin over-collateralization. STRD pays a 10% annual cash dividend, but the effective yield rises to 12.5%. This is possible because the note currently trades slightly below par, meaning investors receive the same dollar coupon while paying a lower price, which pushes the effective yield above its base coupon rate. This is common dynamic in credit markets where coupon and yield diverge based on the trading price relative to the par. From a tax perspective, the tax equivalent yield reaches 19.9%, showing what a US investor in the highest tax bracket would need to earn on a fully taxable instrument, such as corporate bonds, dividends, or bank interest, to match STRD after-tax cash income. The structured tax-efficient treatment is one of the reasons credit notes appeal to investors seeking reliable cash flow without the full tax drag of traditional fixed income products. Where STRD stands out most is its collateral coverage. The product carries a Bitcoin rating of 4.8x, meaning each dollar of STRD is backed by roughly $5 of Bitcoin. This deep coverage provides a wide margin of safety and a meaningful buffer against market volatility. In practical terms, Bitcoin would need to decline nearly 80% from its price at the time of reporting before the collateral value approaches the loan principal. Comparing STRD to STRF helps highlight these nuances. STRF pays the same 10% coupon but shows a lower effective yield of 9.1% because it rates above par, not below it. Investors willingly pay a premium for STRF due to its longer duration, around 11 years, and even stronger over-collateralization, around 7.5x, which lowers perceived risk and compresses its yield. STRD, by contrast, offers a shorter duration and slightly lower collateral coverage, and because it rates under par, its effective yield is higher. Against comparable income products, US high-yield bonds, leveraged loans, preferred stock ETFs, and emerging market debt, STRD delivers the highest effective yield while simultaneously offering collateral backing and senior claim priority. That combination creates an unusual profile in today's market: high cash flow, strong asset coverage, and a predictable long-term structure, all supported by Bitcoin reserves. Now on to STRC. Stretch represents the most conservative profile within strategy credit suite. Unlike long-duration credit instruments that target the highest possible yield, STRC is explicitly designed to deliver stable, predictable monthly income while keeping price volatility extremely low. In practice, STRC behaves far closer to a money market or T-bill alternative than a high-yield bond replacement. The product pays a variable monthly cash dividend which adjusts as market interest rates move. The variable rate mechanism smooths price dynamics and keeps the instrument anchored near its reference value, avoiding the discount premium swings that fixed coupon credit notes may experience. The result is a structure engineered for consistency, a 10.4% effective yield with a historical 30-day volatility of only 8%, which is remarkably low for a crypto-collateralized instrument. A defining feature of STRC is its 5.8x collateralization of Bitcoin. For every dollar in STRC, nearly $6 of Bitcoin sit in the reserve, providing a deep buffer against market stress. While short-term treasury bills, commercial paper, and money market funds typically carry minimal volatility, they also offer just 4% yields at best and are fully taxable for US investors. STRC distributions, by contrast, can include tax advantage returns of capital components, boosting the instrument tax equivalent yield to 16.5% for individuals in higher tax brackets. This combination of high collateral, low volatility and efficient taxation makes STRC a compelling choice for those seeking simple, stable yield without extending into long-duration credit risk. Although STRC targets different outcomes than its higher yield siblings, a quick comparison highlights the structural distinctions. STRD and STRF both pay fixed 10% annual coupons and carry much higher durations, which introduces more price variability as interest rates shift. They also exhibit higher effective yields driven by trade discounts or extreme over-collateralization. STRC, by contrast, is shortened in nature, adjusts its payout monthly, and is engineered to behave more like a high-yield money market product than a bond substitute. In short, STRC prioritizes stability and consistency, while STRD and STRF prioritize long-term income maximization. Lastly, Strife sits in a different category from the other strategy credit products because it blends quarterly income with equity-style upside. Instead of being purely a credit instrument backed by over-collateralized Bitcoin, Strike includes an equity conversion component tied to Microstrategy, which effectively gives holders leverage exposure to Bitcoin long-term appreciation. The product pays an 8% annual dividend, but because part of that distribution is treated as a return of capital, the adjusted tax equivalent yield reaches 21.6% for investors in higher income brackets. The rest of the return potential comes from the 33% equity component, meaning roughly one-third of Strike value behaves like equity exposure throughout an embedded right linked to MicroStrategy. This portion participates in upside as Bitcoin and MicroStrategy appreciate, while the remaining credit portion benefits from 5.2x Bitcoin over-collateralization, providing meaningful downside protection relative to direct equity ownership. With an effective yield of 9.1% year-to-date, performance around 10%, and volatility of 28%, Strike sits between traditional equity and credit, offering more stability than pure Bitcoin exposure but significantly more upside than typical income products. In short, Strike is designed for investors who want consistent dividends with asymmetric upside, combining structured income with a built-in equity accelerator. One of the most compelling aspects of MicroStrategy preferred securities is the tax treatment of their distributions. Because the company continues to generate negative tax earnings and profits, the dividends on STRK, STRF, STRC, and STRD are classified as return of capital, which means the tax burden is deferred rather than imposed immediately. Instead of being treated as interest income taxed at 37 to 55% for qualified dividends taxed at 20 to 35%, these payouts reduce the holder cost basis and carry a current tax rate of 0%. This structure allows investors to capture high cash yields without the typical tax drag seen in bonds, money markets, or traditional preferred stock. When combined with deep over-collateralization and Bitcoin-backed security, the return of capital framework turns MicroStrategy preferreds into a uniquely tax-efficient fixed income alternative, offering income today while pushing the tax event many years into the future. Now on to some highlights from their earnings call. So regarding credit rating improvements, so Bitcoin must eventually be treated as a full capital asset under Basel and S&P frameworks. Early signs banks are considering Bitcoin as collateral, US housing agencies suggesting Bitcoin-backed mortgages. As frameworks evolve and Bitcoin gains institutional acceptance, ratings should improve. Strong capital markets access and proven ability to service debt during bear markets also support future upgrades. Now on to regulatory and institutional shift. So Genius Act and clearer US regulation are driving big banks toward crypto. Morgan Stanley now allows and even recommends Bitcoin exposure of 5 to 6% to wealth clients, also underwrote their recent offering. Crypto industry at the moment of the reporting was 3.9 in trillion size, with 700 million users, 300 million Bitcoin holders, and Bitcoin is a core capital asset. Now on to strategic vision. So digital credit is viewed as the killer app of digital capital. Most compelling model is digital treasury company issuing credit backed by digital capital. There are fixed capital risk rules based on Basel treatment of Bitcoin, and this will be critical, similar to how fixing FSSB accounting was transformative. Now on to banking evolution. So US banks expected that in first quarter of 2026 to buy Bitcoin, sell Bitcoin, custody Bitcoin, and issue credit/margin lines against Bitcoin. This would accelerate adoption and strengthen Bitcoin's role as collateral. And now what needs to happen? The company says that they need to educate banks, insurers, credit agencies, and traditional fixed income investors about Bitcoin as superior collateral/capital. No need for the new laws. They need industry education and institutional onboarding. And lastly, capital allocation and shareholders' value. The company will pursue anything that increases Bitcoin per share and protects return of capital dividends for preferred holders. Buybacks exist as an option but are not a primary strategy, and management targets extremely large value creation over 10 years, expecting payoff within roughly 4 years, and never operates on short-term/month timelines. Lastly, one of the reasons I become interested in covering this company now is its price action, which has been anything but pretty. From an RCI perspective, the stock is oversold on the weekly chart and the Bollinger Bands are showing a move 2 standard deviations below the average price, placing it at levels last seen in September of 2024. This still does not feel like an accumulation zone for me, yet I believe it is valuable to understand the company before lower prices potentially arrive, so I can decide whether it is worth staying away or not. Here you have it. To the best of my abilities, a full breakdown of the strategy previously known as Microstrategy, business segments and their plans. They are attempting to reshape capital markets by first accumulating Bitcoin when it was far less popular, then accelerating that effort throughout the issuance of convertible notes, and now advancing to a new preferred instruments that broaden the ways in which they can accumulate additional Bitcoin. Their ability to survive the 2022 bear market and remain committed to their vision inspires confidence that they truly aim to revolutionize capital markets. Although any attempt to be a disruptor naturally brings periods of extreme uncertainty. This is why understanding their strategy and financing approach matters today, since panic tends to shift all attention toward what can go wrong, while almost no one focuses on the potential opportunity. I view Bitcoin as a hedge against the devaluation of the dollar, and MicroStrategy could represent a bet on the integration of Bitcoin into traditional financial markets, giving the asset a practical use case beyond simply being a store of value. Okay, this is it for today's video, so you can find full written breakdown of this topic on my Substack. Also, for more daily insights and market updates, check my X account, and for more educational content, check my website. Links for everything will be in the description of this video. Hope you like it. Like and subscribe as a sign of support, and see you in the next video. Bye.